We talked about financial inclusion and all, but why did it come out? That is because of the changing landscape of the financial environment. But for the change in the financial environment, I don't think there would have been other basic things like financial inclusion and all. And that has thrown a lot of issues. Now, let us just get into the brass tacks of how the financial landscape has changed. So, what we propose is we will share our thoughts on certain segments. I will share my thought mainly on non-banking finance, and Mr. Dash will on banking, and Dr. Mishra on insurance, like that. And then we will leave it to the audience for raising issues, which will be more interesting than us making kind of monologue on that. Now, the Indian financial system, when we talk about it, comprises several segments broadly. You got the commercial banks, you got the cooperative banks, then you got the non-banking finance companies, then financial institutions, then the insurance, and now one of the other which has gained is the pensions. This is another broad canvas. Of course, there are subsect and that. Now, when we look at this, banks continue to be a dominant component of the financial sector, and followed by the non-banking segment, and then you got that PF in that financial, and then insurance is another very big segment having its own function. It's a huge one. And over the period of time, some changes have taken place. I leave it to Dr. Mishra without trampling on his area. Now, when you look at this banking, banks are no longer has been doing a routine job. If suppose 15, 20 years back, if you go to a bank, except the board, you will not find any difference in what they are doing. You go to any bank, they will give the same thing. I was working as a commercial bank manager when I went to institution to ask deposit. He said, what is that additional thing that you can give than other banks? I just couldn't say anything because everybody accepted deposit, everybody gave loan. That's all, nothing else. I couldn't say anything except that I said, sir, we are new to this state, so we are nascent, you encourage. He said, no, that is not an argument. He said, everybody says they are new. So what I am saying is, that is not there now. When I was working in the public sector bank board, I used to tell the chairman, why don't we make our bank, though it is public sector, a different one than other banks, so that we will be a niche bank for product. He said, no, we cannot do that because ministry will tell us we cannot be different, we have to grow in the same way. Their major objective was increasing the balance sheet side more and more and more. That's all. But today things are different. You can choose between banks based on the services offered. At this point, I stop and leave it to him. Now, when it comes to the next segment called non-banking finance companies. Non-banking finance companies, they were once not regulated at all, except collecting some statements. And they were collecting deposits, mind you. They were collecting deposits and they were not regulated. And you can understand what happens when you are freely allowing somebody to collect deposits and you don't regulate. And when they pay high interest, what they do? They have to deploy the funds in a place where they get much more than what they pay to you. And don't ever think that money comes free. Money is never free lunch in finance. So what they used to do, they used to invest in real estate, they used to win some speculative sector, and when that collapsed, they did not collapse. They continued to live, but the depositors collapsed because they lost the money. And this happened in a huge number, especially this took place in Tamil Nadu. I am not talking about anything of recent. I am talking about the whole old thing. And the Reserve Bank stepped in that we have to regulate and control them. The first and foremost thing they said, Should we allow them to accept deposit at all? This was a fundamental issue was raised by Reserve Bank of India. At the same time, we also felt somebody who is already accepting, if you say don't accept, then what do they do? How do they service their existing assets and liabilities? So as a first step, what we did was, though we did not say formally, we stopped giving, we said that all these companies must get registered with us first. And while registering many of the companies, there were about 56,000, 60,000 companies. Out of that, we rejected almost many of them, and we allowed only about 12 to 13,000 companies only we registered. All of the others had to go because either they were defunct or they were not in a position to meet it. And later on, we took a policy that none of these new companies will be allowed to accept deposits. No more acceptance of deposit by new companies. Only the existing companies were allowed to continue with that, but there also we get ceilings on the deposit which they can accept. And then later on we said, if your capital is not adequate, we put a ceiling somewhere about 2006 and 2007 that you cannot exceed more than what you are having now. That also we brought in. So slowly if you find the amount of deposits which we had has come down from several thousand crores. Now if you look at the RBI balance sheet, the deposits are around 2,000 crores or something like that, and that too increased now. Earlier it was much less also. And now they have developed the capability of raising funds. So the first and fundamental thing we said is that you cannot accept deposit because it was impossible for Reserve Bank to control 12,000. Even today there are 12,000 companies. We cannot. Now then the next step what we did was, we recognized this non-banking financial sector is very, very important credit delivery mechanism. Now why they are important? If you go to a commercial bank today, though they make lot of advertisements, you come to her, we'll give home loan, that loan, this loan. You start entering into the process of that, you will find how difficult it is to get a loan. It's very difficult. The kind of terms, the condition, the follow-up, sometimes the borrower may get frustrated with that, especially the small and medium sector and all. It's very difficult. I am not saying they are wrong because their worry is something different. Their worry is about credit creations and all. And that is why when we talked in financial inclusion, the government and Reserve Bank came with what is known as subventions and mandates to ensure, to force them to give, like priority sector, MFI loans, interest like that. Now when we started looking at this, that what is to be done, that this kind of thing, we said that non-banking finance companies are much more agile. They could give the loans in time, faster, and without much hurdles or rigorous procedures. But whatever they said, they could do it faster and give to you. In other words, you found a mechanism which is much more formal but less rigorous than the commercial bank. Now, if these NBFCs were taken out, what was the other thing? There are informal lenders. At the lower level, we call them as money lenders, and SMEs and all go to money lenders also. And that money lenders, they give you immediately. There is no delay at all. For example, a commercial bank, if it takes say 1 month, a money lender gives it across the table and finishes it off. Now you may wonder then that is the best system. No. The problem is that the rates of interest are huge. Second, they don't even ask for security or anything because they believe in their ability and muscle strength to collect the money. A bank will always believe in documents and going to the court, and you know what happens to the court. That is why a good borrower who wants less interest goes to the commercial bank and doesn't get it, but he goes to money lender and get caught. Whereas a person who is ready not to pay, he is prepared to sign any amount of document. He knows what is the big deal. You sign the document, go to the court and wait for it and go on and on. And any case goes to the court, I think it never gets resolved. And now we set up, we came with Sikh Industrial Unit program, we came with DRTs, we have got surfaces, but even today, the non-performing assets and its recovery is a huge problem today. Now therefore, we thought, allow NBFCs, they don't touch the public fund directly by deposit, but they go to the banks and all raise the money, and then they give the loans. Of course, the rates of interest are slightly higher and the rigorous caveats are there, but we found that it's a system we should grow. Today, the size of the non-banking finance companies, we call only one particular segment is almost 10 to 12% equivalent of the commercial bank's credit. You can understand how huge it is. Now, we wanted to regulate these NBFCs, but regulation does not mean you keep on issuing instruction and saying don't do this, don't do this, don't. No, we said how you do this. This is the most important thing between commercial bank and NBFCs. We started telling how you have to do the business rather than saying not do the business. Whereas in the case of commercial banks, we are very clear certain things you cannot do at all. Now, therefore, we classified these non-banking finance companies into two divisions. One is the deposit taking companies and non-deposit taking companies. And in the non-deposit taking companies, systemically important and non-systemically important. Systemically important are those whose assets are above 500 crores and others are non-systemically important, less than 500 crores. But again, in the less than 500 crores also, we didn't want to regulate all of them in the same way. I don't think that if you should put everybody in one jacket and do. When these NBFCs, we said if they are going to raise public funds, then you regulate them differently. What is the meaning of public funds? It is not deposit. It could be debentures. It could be from other companies. It could be what you call as bank borrowing. That is, these are all indirectly you are getting money from the public, whether it is bank borrowing or not. They are all from the ultimately public, and if they are not functioning efficiently, if these people suffer and ultimately the borrower, the lender suffers, they are the common people. So we said differentiate them. If any NBFC less than 500 crores do not have any borrowing from any public entity, then no regulation, virtually no regulations. But if they have customer contacts, again linking back to financial inclusion, we wanted to protect the customers, and therefore we brought in provisions to ensure that the borrowing customers do not suffer. I'll just give you an illustration. What is this? When an NBFC gives a car loan, and if the car repayment is not there, there are several occasions when you are driving the car, the recovery agents will come and stop the car, take the key from you, ask you to get down and drive the car away and go. And some of the cases where the agents will go to the home, regularly morning they will go and shout. You can understand what kind of torture of these things that. So we wanted some amount of flexibility and compassion. You cannot just because gave a loan, you cannot just go and harass them. And therefore we brought customer service issues. Now in the case of microfinance, see microfinance, what happens? Microfinance is mainly for the contract laborers, low women, working in the village, small entries and all. Now they have only a particular ability to borrow. They cannot borrow, let's say, beyond 10,000 or 15,000. But some of the companies, what they did, since they are regular in payment and all, they force them to take more loans than what they are even capable of, and fixing very high rate of interest, of course better than money lenders. As a result, they suffered. So the first crisis took place in Andhra Pradesh, and the government intervened, and that put a lot of problem for the microfinance company. All of them virtually became, I should not use the word defunct, they suffered. And therefore, Reserve Bank came in the way and brought again customer service. The rules brought for microfinance are so designed to be very customer friendly. Now, after that, you will not find any microfinance institution has suffered. They are now recovering and they are coming back, and the system is functioning. And microfinance is a very, very important segment of last mile financing for small borrowers. And the number of amount that is outstanding is so high. In fact, some of them are so matured, and this time when Reserve Bank of India gave small bank finance license, about 8 of them got license. They have been matured enough to be a bank. So what we have done is to clear the pathway, make it less thornful and more customer friendly, well regulated, to ensure that these companies are financially strong and ensure a right credit delivery mechanism at a right price in favor of customers. But when they are borrowing from the public sector, I mean banks, I think, we said that we will subject them to regulations. Whereas if the balance sheet is more than 500 crores, we said whether you borrow or not, you will be subject to regulation. Now that is because when they grow beyond a particular size, their interaction with the financial markets are high, maybe in forex or in capital markets or otherwise, so that if anything happens to them, they cause disruption in the financial markets. Second, if they are not credible, they contaminate the financial markets quality. Now we don't want either of that. That is why we put stringent regulation almost equivalent to that of commercial banks, and now recently in the past 2-3 years, even the Reserve Bank of India's inspection on them has become very tight. Please remember, they are not supposed to accept money, new deposits and all. Deposits accepting activity is not there for new companies. So now what happened? From a disorderly, indisciplined and bad intentioned publics, the non-banking finance companies, largely. There are good companies like Sundaram Finance right from that. They are good. The good companies continue to be good. Now to a sector where it is so clean, financially sound and well regulated, so much so, you will really be very happy to know lot of foreign development, foreign institutions invest in these companies and acquiring these companies. And then you can understand the status, how it has migrated. So what we did was, notwithstanding, as Mr. Khan said, just because accident takes place, you don't stop driving or manufacturing cars. We said let make the discipline much better. And of course in traffic, I don't think you can do, whether it is Bhubaneswar or Bombay or Bangalore, it will continue. But in financial lanes, we brought in enormous amount of regulation so that accidents are minimal, and it offers comfort for the traveler, it offers good speed and safety. So we have migrated, and today we have got more than 200 companies which are systemically important, and more than about 12,000, 11,000 companies which are not systemically important, but all of them are monitored. And we have also allowed them to take part in forex markets, derivative market, but as a not as a trader or anything, but for their own purpose. That is for their own business purpose and not for any other speculative or any other thing that is left only to the commercial banks. So we are migrated from a very chaotic condition to a very orderly condition, and if 5 or 6 years back getting an NBFC registration was very simple, but today getting an NBFC registration is equally constrained as it is in the case of commercial banks, because the amount of scrutiny that is done is something phenomenal. I'll give you one simple case to what extent RBI scrutinizes. In one particular case, we found that one of the investor, when we searched the Google, we found that they are linked to a Russian company, and that Russian company was under this money laundering case pending in United States. At that time, which they were not doing, which they were not knowing that company, they took him. And when we started questioning it, and we never revealed this, and in fact one of the director was a very senior police officer. He came and challenged me. I said, why is it, why are you coming in the way of a thing? Your job is to help us, why you are not doing? I said, I will help you, but because you are a very senior police person, I am telling you, did you know this has happened? He said, no, we don't know. How did you know? I said, it is very simple. We just Googled and got the information. This is what is there, you take it. He was amazed at the kind of scrutiny we did. Now the scrutinies are quite strong in RBI. And I am telling you, RBI now it is, see, you are seeing in wrong limelight now. But the amount of work that is done by Reserve Bank of India in every segment to ensure the financial system is safe for all of us is enormous. So at this particular point, I'll stop saying that this is a brief evolution of one segment of the financial market, that is non-banking finance companies. And please remember, non-banking finance companies does not mean they just give loan. They specialize. They are in microfinance, they are in infrastructure, they are in factoring, they are in housing, they are in commercial trade, they are in real estate. They are all not homogeneous. They are different, but they finance in different segment specializing. For example, one of the company, that is IDFC, which was infrastructure, it has become bank. Microfinance, they have become bank. So please understand, this non-banking finance companies is a growing segment, and their credit, these 200 companies, aggregate credit itself is more than 10% equivalent to the bank's credit. You can understand, 200 companies just. And the growth of credit of them is almost 25%, as against the growth of bank credit. Last time it was about 10% or 11%. So it's a very growing segment, and providing connectivity to those economic activity which feel that they can get much faster finance and well regulated without hurting the interest of the common man, namely depositors otherwise. I'll stop here and invite my colleague. We were all in Reserve Bank, so that I invite Dash to talk on the evaluation, how the financial sector change has taken place through banking.